Bloomberg Audio Studios.
Podcasts, radio, news.
This is the Bloomberg Surveillance Podcast. I'm Jonathan Ferro, along with Lisa Abramowitz and Anne-Marie Hordern. Join us each day for insight from the best in markets, economics and geopolitics. From our global headquarters in New York City, we are live on Bloomberg Television weekday mornings from 6 to 9 a.m. Eastern. Subscribe to the podcast on Apple, Spotify or anywhere else you listen. And as always, on the Bloomberg Terminal and the Bloomberg Business app. We begin with our top story, Alphabet and Tesla results failing to impress investors as earnings season continues to ramp up. BlackRock's Kate Moore writing the following. Early reports suggest a potential continuation of first quarter trends. Auto, industrial, cyclicals, not yet out of the woods. Consumer spending remains tepid and companies with positive earnings momentum into a slowing economy will be rewarded. Kate joins us for more. Kate, let's talk about the theme and welcome to the show. It's been too long, as always. Let's get straight into it. Good to see you. The small caps ripping in the last couple of weeks. You don't think it's that durable. Let's start there. Why not, Kate?
Yeah. I mean, we could have like a whole conversation about this, John, but there are a few reasons. I think the most primary reason here is that small caps tend to perform when the economy is improving, when the second derivative of economic growth is positive. And we're at a point right now where I think we can all agree the economy is slowing, maybe not at a dramatic pace at this point, but in such a way that the Fed should be able to ease policy rates sooner rather than later. And that environment, that slowing economy, is not generally good for companies that are price takers, that are in lower on the supply chain, and that tend to not have the diversity of businesses that their large and mega cap peers do that cushion them through different parts of an economic cycle. I also want to point this out, because people have made the small cap argument around the debt profile. Hey, small caps have a lot of floating rate debt, and that's going to be great when the Fed starts cutting rates. Well, they need more than 25 or 50, or in many cases, 75 basis points of rate cuts before it really has a significant impact. And I want to note that a lot of the debt for the small caps comes in the form of bank loans. And we need banks to feel confident enough about the economy to be extending those loans to the small companies at the same time. So I think this is a tactical, technical, and sentiment-oriented play, and not really based on the fundamentals of small companies.
It also is based on valuations, Kate, at a time when you're still seeing some of the big tech names really garnering some pretty high elevations. You've been overweight some of the AI names, some of the big tech darlings, and even you seem to be cooling on the margins about just how much further they can go. Can you explain the sort of bifurcation of not being particularly positive on the small caps, but also sort of seeing some of the large cap beloved stocks losing some luster?
Yeah, you're right. It is a little bit of a tricky point, and I hopefully want to get to a point in the fall where our view changes a little bit. But we've been trimming a little bit of our what had been a very significant tech overweight over the course of the last number of weeks, since it's really kind of late spring, and much of that has to do with the incredible performance we saw in the first half of the year. And as you point out, we've traded at premium valuations for lots of these stocks. We don't actually think most of these AI-oriented companies are going to have trouble with their earnings. Remember, they're later reporters. They report kind of late next week or in through August. I think those are going to be the real show me moments for the theme. That said, when we're at these kind of price to perfection levels and we're at such huge premiums to other parts of the market, it's just good risk management to trim a little bit. I just also want to emphasize, though, that our enthusiasm for the AI theme has not diminished. This is more of a tactical and portfolio construction move that we've made.
Which might explain why other people seem to have a similar kind of sentiment, at least based on the price reaction to Google shares after their earnings that were largely better than expected. Just when you dial this forward, if you're marginally selling some of the large cap names and you're not buying small caps, what are you going into?
Well, we've kind of marginally sold a little bit on the AI and tech-oriented names, but we've done a little bit of sector rotation. Nothing dramatic. We're not buying into sectors we don't have a lot of conviction in. I would say we're not adding to consumer staples at this point. But, we've been selective around banks. I think there's some opportunity there. We see some very high quality balance sheets and opportunities. We see some opportunities across energy, stuff that has gotten exceptionally cheap. And we're going to continue to kind of monitor both the growth story that could impact energy as well as the policy side. And then I would say there are parts of consumer that we do like. And we are being selective there. You mentioned just a moment before I came on that there has been very mixed news, particularly for the low-end consumer. But there are consumer companies, maybe experiential consumer companies, or those with very specific and well-loved brands that we think can be resilient even in a slowing economy. So let's just say this. We're being more selective, and we're kind of trimming on margin stuff that has run very, very hard, but not giving up on the theme.
You named a range of sectors. One I just want to tease out and build on that, and then we can go to others. Kate, energy. And you mentioned some policy considerations. Can you go a little bit deeper? How are you thinking about that sector?
Well, I mean, energy has the potential to look quite different in 2025 under one administration rather than another. And we're going to be paying very close attention to what happens in the November election, not just at the presidential level, but also at the congressional level, and kind of how the tone might change towards traditional energy versus renewable energy, and which parts of that complex have the best legs for the next couple of years. I will say, even though we're talking about slowing growth, we're not talking about catastrophic growth. So we think there's underlying overall demand for traditional energy. And we've continued to see that type of capital discipline that we've talked about many times in the traditional energy companies, which is leading them to look fairly profitable and to generate cash. So there's a lot to do there, and I think it's kind of an interesting and exciting sector given potential policy changes in the U.S. and elsewhere, and that may lead to some rotations within the industries in the sector.
Kate, can you just drill down into exactly what you're looking at and how the rhetoric potentially can mean an investment decision? Because under Biden, energy stocks did do well, and we're pumping at least crude natural gas, the most any country has ever produced on record, even though the former president, Donald Trump, says he's going to unleash America's liquid gold. So how do you put some of this rhetoric into a position?
Yeah, I mean, I think this is a great point. In any political cycle, there is a huge gap between narrative and reality. And when it comes to energy, you pointed this out very well, there was an enormous gap between negative rhetoric and actual reality. So here's what I will say. We have to understand what the consensus thinks. We need to understand how people, not just ourselves, are interpreting policy. And we need to position ourselves around that, not just around the real impacts of policy. It's kind of like the second derivative. It's understanding behavior, it's understanding sentiment, and it's understanding how people have gone into changes in rhetoric and the narrative in terms of their positioning. So it's a little bit of art, I would say, Emery. This is kind of one of the fun parts of investing. I think there are lots of parts of policy outside of energy, for example, that could look a little different in 2025 under either administration. We've been spending a huge amount of time, and there's a lot of the street been talking about one set of trades versus another set of trades. I have to say, I think it's premature. I've made this point multiple times, and I'm going to just underscore it again. Congress matters. And at this point, we don't have a great sense for how the down ballot votes are going to go. And if we have a sense, let's say at the end of November, for what the composition of Congress is going to look like, what kind of policies could actually be enacted, I think it's going to be an easier time to put on a more specific U.S. policy trades than today.
You've got to wait. Kate Moore of BlackRock. Kate, thank you. Appreciate it. Thank you very much. It's the latest this morning. Israeli Prime Minister Benjamin Netanyahu speaking before Congress at 2 p.m. Eastern today, where he's expected to try to shore up support as the war in Gaza continues. Netanyahu is set to meet with President Biden and Vice President Kamala Harris separately on Thursday, followed by a meeting with Donald Trump on Friday. Aaron David Miller of the Carnegie Endowment for International Peace joins us now for more. And I want to get to this question. President Biden is a lame duck president. We all understand that. Do you think that gives him less space to deal with the likes of Netanyahu, or more space to find an agreement?
I mean, look, I think from the beginning of this conflict, thanks for having me, John, the tone, the trajectory, the motives, the calculations, escalation, de-escalation have been set by the two major combatants, Israel and Hamas. If there is a deal, and I suspect there's a reasonable chance by mid-August that you actually could achieve one, I think it'll have more to do, frankly, with changing calculations on the part of Hamas and or Israel, particularly Mr. Netanyahu, than it will be with American pressure on one hand or American persuasion on the other.
Aaron, we have commercial ships in the Red Sea still under threat. We have 5 Americans still under hostage from Hamas. What kind of deterrence do you see from this administration currently?
You know, I think, and there are many feelings about the administration's policies toward this war, but I think the one issue that they've been relatively successful on is preventing what I would describe to you as a major escalation. Certainly, the Houthis are going to remain a problem. I mean, they are a keeper. There's no question about it. They are, according to some analysts, the southern Hezbollah, and they've demonstrated that they have reached. They launched this Samad drone 1,300 miles from Yemen into downtown central Tel Aviv. Not even Hezbollah has done that. So I think the administration has to deal with a certain number of realities, and one of those is that Iran has benefited greatly from the use and exploitation of their proxies. And there's very little, frankly, pending some transformative agreement between the U.S. and Iran, highly unlikely, certainly between now and the end of this administration, or probably for the next. So that's a problem that the United States has no solution to, and it's going to have to try to manage to the best of its ability.
It feels like we continuously see red lines crossed when it comes to this conflict, but especially when it comes to Iran. What is the policy currently from the Biden administration?
Management and de-escalation. And look, in fairness to the administration, frankly, any administration, I work for a Republican and Democratic administration, we have a strategic problem with Iran, both on the nuclear side and with respect to their use of proxies in the region. And we have no strategic solution. The reality is you have a regime that is highly ideological and dangerously pragmatic. It's expanded its reach now in creating a virtual alliance with Putin and his war against Ukraine. It's backed Hezbollah, the Houthis, Hamas in Gaza, at little cost and expense to itself. The Iranian problem, unless there's a change in regime, in my judgment, is going to be a management problem. It's not pretty, it's not emotionally satisfying, but frankly, it's a cruel reality. I just don't see the alternative right now.
So given that that's sort of an ongoing simmering issue, looking inward, you've worked with both Republican and Democratic administrations when trying to manage this situation and the implications for Israel. Have you ever seen such a big divergence between Republicans and Democrats in terms of support for Israel?
I mean, I think you really broke the code. You have a degree of polarization and the fracturing of bipartisanship that is unprecedented in this relationship. The Republican Party, and again, I voted for Republicans and I've worked for Republicans, maybe not these kinds of Republicans, but the Republican Party has emerged as the Israel can do no wrong party. And the Democratic Party is split, not just between progressives and mainstreamers. You have mainstream Democrats, Chris Coons, Chris Van Hollen, Chris Murphy, who at one point or another over the last several months have publicly called for conditioning military assistance to Israel. So what is at stake here? I think literally, for the first time in the history of the U.S.-Israel relationship, is a debate between Republicans and Democrats and within the Democratic Party about what it actually means to be pro-Israel. And that, for anyone who is interested or cares about a strong, healthy U.S.-Israel relationship based on reciprocity and trust, that is a very worrisome development.
So what is a pro-Israel point of view from the Donald Trump camp versus the Kamala Harris camp?
Well, I think you look, all presidents are blind dates, right? So no matter what their resumes are, when they get to the White House, they essentially are going to be tested. You've had 4 years of a trial run with Donald Trump. And again, I'll say it again. I voted for Republicans and Democrats. I've worked for Republicans and Democrats. I think it's fair to say that Donald Trump, whose conception of the national interest, frankly, is transcended by his own personal interests, and tethering to his political interests, created what I would call, as a believer in a strong U.S.-Israel relationship, a sort of a sugar high for Israel. A series of goodies, pro-Israeli gestures, and policies which were very pro-Israel and appreciated certainly by Benjamin Netanyahu, with whom the former president has a sort of Vulcan mind meld. But on balance, the Trump administration, even though it deserves credit for the Abraham Accords, also had no serious, significant policy or approach to managing what I think is probably the greater challenge that the Israelis face, and that is what to do about the Palestinians. You have 15 million humans, and let me deploy river to the sea here in an educational context. You have 15 million humans living between the Mediterranean Sea and the Jordan River. What are you going to do? How are they going to coexist? In my judgment, the only rational, even though it's more attuned to a galaxy far, far away than back here on planet Earth, is separation through negotiations. And the Trump administration took an approach on the Palestinian issue, which essentially discounted it as a factor. And I think we see year after year after year that this problem, the Hamas terror surge, brutal Hamas terror surge, is not a manifestation, in my judgment, of what the more rational elements within the Palestinian community want and believe they can actually achieve for their people. So focusing on Palestinians, I think, is critically important, however grim the future of a two-state solution is right now.
Aaron, we've run out of time. That was deeply thoughtful. The subject has always been polarizing. It is even more so in 2024. Aaron David Miller of the Carnegie Endowment for International Peace. Stephen Trent of Citi joins us now for more. You're surprised there weren't more than that. I think other people are too. Stephen, let's get into this. Typically, when you see outages like this, there is this favourite word of economists that we often hear by analysts as well, transitory. It sort of comes and goes, we move on, it doesn't leave a scar on the stock. Stephen, do you think this moment is different for this airline, which, excuse the pun, has been flying high for quite a while now in this country?
Oh, thank you very much for having me, and good morning. So when we see outages like this, this is a little worse than what would typically see from a network outage or from some kind of weather event. So people think, for example, back to Southwest in December 2022, you saw that carrier's cancellations around the low 70s for a day or two, which is considerably higher than what we're seeing for Delta today. So Delta, we saw a couple of days where the cancellation rates were in the 30s, but indeed it's a couple of days. So Delta did have a technology outage in 2016, and that resulted in, for example, 2,300 canceled flights. At this point, unfortunately, the carrier is above 5,500 cancellations since Friday. So in terms of scale, it is a little bit tougher than most of what we've seen in the past.
Stephen, you know these companies inside out. What is it about how Delta operates that has meant they found it much more difficult to respond and actually make sure they can come out the other side of this faster than the other airlines have? It feels like it's back to business at American, at United. Why can't the same be said about Delta when they all experienced a similar shock?
Yeah, absolutely. So not every airline has the same technological setup. It's conceivable, for example, that the other carriers do not have as much exposure to CrowdStrike, and maybe some of the carriers don't have any exposure. You know, over the last couple of weeks, for example, to its credit, we saw very little disruption with Southwest or Alaska Airlines, for instance. Where Delta, for instance, has something like over 10,000 individual systems that it has to restart as a result of this CrowdStrike outage. So the relative exposures are not the same.
I guess there's a larger question here, Stephen, and we've been asking it in terms of how do you diversify away from being so dependent on one system that you could be vulnerable to this type of thing happening? Has anyone been examining the vulnerabilities, not just in Delta, but other airlines as well, in terms of, you know, United was really sunk when there were problems with specific Boeing planes. There is this question now with Delta and CrowdStrike. Are there sort of key vulnerabilities that people are studying within the airlines that could sink entire systems all of a sudden in a flash?
Yeah, it's a hard one because I think the group thinks about these kind of risks all the time. So, for example, today, exactly as you said, if you're an airline that's operating only Boeing 737 MAXs, you have a different set of supply risk, for example, versus a competitor that has Boeing, Airbus, and Embraer planes, for instance. So that's always a risk. In terms of whether these airlines need to have different systems set up, that's something that I think the group is probably going to be looking into. At least elements of the market are going to look into that. On the other hand, there are other risks with having too many suppliers. Just look at global supply chain today. You basically need everything to go right. And I know it's not exactly the same situation, but you need everything to go right. And 2 or 3 suppliers can really, screw up the works, so to speak. So I think in this case, certainly, I would imagine that elements of the group are going to be looking at how to have some fail-safes in their technological supply going forward.
I was struck by the Delta union saying pilots felt, quote, abandoned basically by the system and the company. How does Delta then close basically the trust gap they're going to have with their flyers, but also their staff?
Yeah, so I think you have a situation like this with thousands of flights canceled. Very easy to say that for anybody involved, it's a very emotional situation. And I don't want to dismiss what frustration you may have from pilots or customers or flight attendants. Certainly they have very real frustrations, and many of them have had really bad weeks. I get that. I think when the dust settles on the root causes of this and how it might be mitigated going forward, I wouldn't say it's fair to take, the worst point of consumer and employee anger and project that forward. This problem did not start with Delta. Delta is not the origin of this technological problem. They are collateral damage, as were hospitals and 911 call centers in various places. So I think the actions that the carrier takes going forward present an opportunity in terms of its relationship with those constituents.
Stephen, great to get your thoughts, sir. Appreciate it. Stephen Trent there of Citi. This is really noteworthy this morning. On Bloomberg Opinion, former New York Fed President Bill Dudley out with a bold call, saying the central bank needs to move, writing this: "The facts have changed, so I've changed my mind. The Fed should cut, preferably at next week's policymaking meeting. Although it might already be too late to fend off a recession by cutting rates, dawdling now unnecessarily increases the risk." Joining us now to discuss is Michael Kushma of Morgan Stanley, alongside Derek Burleton of TD Bank. Michael, I want to come across to you first. What did you make of Bill Dudley's note this morning? Let's go. Let's move.
Well, we've moved a long way in terms of the actual economic performance of the U.S. economy. We're growing much slower than we did last year when we had all the bull market expectations of rate cuts. We got through the inflation blip in Q1 where we had the surprising very sharp increase. Now we're back to that deteriorating trend or improving trend of inflation. By the end of the year, we're likely to get to sort of the Fed's forecast for inflation targets. So we should be having less restrictive policy. But the question is how much less restrictive policy?
I can feel the consensus move, and I think we all can, based on the conversations and how they've developed over the last few weeks. But things are still pretty split. Goldman say, why wait? We had Barclays on the programme yesterday saying, why not wait? Derek, which camp are you in going into this July meeting?
I'm in the wait camp. Things are slower, but they're not slow. And we'll get evidence of that in tomorrow's GDP data, personal spending data on Friday for June. Inflation has rolled over, which is great news, but you still have an economy that's fairly resilient. And Powell's been saying all along that resilience gives the Fed it affords more time to be patient. So I do think that taking July off and moving in September probably would be the best bet.
Michael, this is sort of consensus that September is the right time to go, that there isn't really a chance of dramatic weakening. And yet in the tone that we heard from Bill Dudley and the tone that we've heard from, say, the Redfin data we've been talking about this morning, about housing deals falling apart at a record pace in June, how much is there a sense that actually the economic data is moving in real time and suggesting more of an urgency?
I don't think there's so much of an urgency for the whole economy as a whole. Clearly, certain interest rate sensitive sectors where it's Commercial property, office property, even more residential property is under stress from high interest rates. But a lot of other sectors of the economy are doing just fine. In fact, the goods producing sector, manufacturing output, is up quite nicely. Talking about the old economy versus the new economy is doing just fine. But the point, I think, is we compare what today's situation, say 1994, 1995. Greenspan pivoted very quickly from rate hikes to rate cuts modest rate cuts in 1995, which kept the expansion going. Policy rates today are restrictive. Why not have less restrictive policy? Not easy policy, but less restrictive. The economy is growing 2%. Inflation is close to target. Do we really need 5.5% interest rates? Get ahead of the game, so to speak, by nudging them lower, but not necessarily initiating a rate-cutting cycle going forward.
Derek, one argument against this, I presume, would be this idea of concerns that it could reignite inflation. That would be the only argument not to reduce some accommodation at this point, given that inflation is slowing. Derek, are there signs that inflation truly is sticky and could reaccelerate, even with a 25 or 50 basis point rate cut by the Federal Reserve?
Yeah, I mean, just look at the service component. It's still quite high. I know we've seen some improvement of late, but I don't think the inflation dragon's been fully slayed yet. And I am on the camp, our baseline is in the camp that, that chance that this is a false dawn, we're going to see another big leg up in inflation. We don't buy into that, but you can't rule out the risk. And for a central bank that is a risk manager, clearly they're taking that into account. So I'm worried still about service inflation. The job market, again, has slowed. Vacancies have come down, but real wages are still positive growth. And, the employment market's still quite strong. So, one can't throw out this notion that you could see a bit of a pickup in spending above trend from below trend in Q2 to above trend in Q3. And I think these are things that the Fed has in the back of its mind when it's trying to balance. Do we move sooner or do we move later?
Derek, they're trying to build confidence about getting back to 2. Your concerns, is this about returning to 4 or getting stuck at 3?
No, it's getting stuck at 3. I think, again, things have changed. I think we need to acknowledge excess savings have been pretty much fully withdrawn, and things have slowed. And those rates that Michael referred to are biting the housing market. Some of these areas are showing more evidence of struggling. And so I don't think we're in an environment to see inflation go back to 4. Now, of course, anything's possible. We're looking at some of the shipping rates backing up. Who knows geopolitically some of the risks. These are not, in the next month or so, but going out next 3-4 months, there are lots of question marks. But yeah, the 4% world just doesn't seem like it. I would put a very remote odds on that. You
gave a nod to the bond market, so let's talk about rates in the bond market. Michael, I want to talk about that now. Lisa's led this conversation this morning. 2-year versus 10-year, negative about 17 basis points. The curve is uninverting, let's call it that, sort of normalizing. I'm not sure we can call it steep. You can say it's steeper, but it's still not steep. Let's put it that way. Still very much inverted. There's 2 ways you can uninvert. It can be led by the front end. 2-year can rally, rate cutting cycle off the back of much weaker than anticipated data, or it can be led by the long end. Long end sells off, yields pop higher, and there's plenty of reasons for that to happen. What are you expecting from the yield curve, and what drives either side?
I think it's clear we're moving to a rate-cutting cycle of some sort. I think a lot of it has been discounted, if not all or more of it's been discounted today with 2-year notes where they are. But I don't think the Fed's going to cut rates enough over the next 6 to 9 months to justify 2-year notes, 4.25 and lower than that. Back end, I think if the Fed is clearly moving in advance of economic weakness, if they do move 1 to 2 rate cuts this year, another one in Q1 next year, it boosts the confidence in the long end of the yield curve. It may slow down the inflation progress on that front, but the balance would be I'd rather preserve employment gains rather than disinflate faster than otherwise. So I think they're balancing off those 2 types of risk, which leads both to steeper yield curves. Moving too quickly or faster than the economy weakens will bolster long-term yields. On the other hand, if they wait too long, long-term yields may continue to drift lower.
It sounds like both you, Michael, and Derek are kind of talking as though you disagree with each other, but agree a little bit more than it actually seems. And it's sort of compelling to me that you said that the 2-year yield kind of has gone pretty far in terms of how many rate cuts it's already priced in. Are you saying that it's something you should fade, the rally at the front end?
thinking about because markets tend to overreact and overshoot. We've seen that. We saw that the fourth quarter of last year, where we had this major rally with 6 rate cuts priced in for 2024, and obviously it didn't materialize. We had a major sell-off in Q1. So I think that I'm not talking about a major sell-off because we're getting closer and closer to that transition point to actually cutting interest rates as opposed to speculating about them at some point in the distant future. But I do think there's likely to be disappointment as how much actually happens over the next several quarters. But the data today has been leaning that direction. We've had, until just recently, weaker economic data, weaker labor market data in some ways, and we've had better inflation data. So how this is not good for bond yields or for expectations of rate cuts, but the cumulative amount seems to be overshooting to the upside. So at some point, if we get 4% 2-year notes, barring some catastrophic risk factor in the world, which flight to quality or flight to risk-free assets, otherwise it looks like we're going to be pretty solid right now.
And Derek, it does seem like you pretty much agree that basically this is just a matter of when they begin to start to tweak some of the policy, not necessarily whether we're entering some massive recession or whether we're actually going to grow strongly. Is there something in the data that gives you confidence that we are not seeing a rapid deterioration that could lead to a more pernicious weakening, which is what basically was sort of the implication of Bill Dudley's column?
Yeah, I think, the June numbers, it's only 1 month, but certainly we had, a series of downside surprises on data. Now is the pendulum swinging a bit towards some upside surprises. It seems to be the pattern of the U.S. economy. You got 3 or 4 good inflation reports and then, 2 or 3 bad ones. So, I just think when I look at the U.S., productivity is still very strong. Employment is still healthy. It's the economy I still think that stands out. So I am not of the camp that we're going to, get close to recession in the U.S., that we're going to sort of grow along at around the 1.5 to 2% clip sub-trend, sort of that Goldilocks type environment, and then we'll, avoid the worst case scenario. As Michael mentioned, there are lots of potential risks. The election, some of the uncertainty there, geopolitically, a lot of potential surprises. But if I look at the U.S. in and of itself, I think it'll do just fine.
Derek, thanks for being with us this morning. Appreciate it. Derek Burleton there of TD alongside Michael Kushma of Morgan Stanley.
This is the Bloomberg Surveillance Podcast, bringing you the best in markets, economics and geopolitics. You can watch the show live on Bloomberg TV weekday mornings from 6 a.m. to 9 a.m. Eastern. Subscribe to the podcast on Apple, Spotify or anywhere else you listen. And as always, on the Bloomberg Terminal and the Bloomberg Business app.